multiple choice questions on non-current assets from the 2016 exams. From the Cambridge Specimen Paper number 1, question 3. A non-current asset costs $250,000 and has a useful economic life of 25 years. The estimated residual value is $10,000 and depreciation is provided on a straight line basis. In other words, what we can do now, before we even go on much, is we can quickly work out what would the depreciation each year be. So the annual depreciation is going to be the $250,000 cost minus the residual of $10,000 that we expect it to have at the end of its life. And so that means that we want to write off $240,000 over its life, and we assume that the life is going to be 25 years. So we divide it by 25. So 240,000 divided by that 25 is going to give us 9,600 per annum. Okay. Then the next thing that we want to work out, after 10 years, the asset is sold for $120,000. Disposal costs of $20,000 are incurred. What is the loss on the disposal? Well, first we need to work out what the carrying value at that particular time would have been. The carrying value would be 9,600 times the 10 years that you've had it, means that the total depreciation would have been 96,000 as the total accumulated depreciation, and your cost was initially 250,000. So if you subtract the accumulated depreciation from that, you would then have a total of 54,000 as your carrying value. You can then work out, it was sold for 120,000. Sorry, I lied, not 54,000. 154,000. So if we sold it for and then we would also incur costs of $20,000. But basically, if we sold it for 120,000, we then have to subtract also that 20,000. So we've got to compare. The loss is going to be the difference between what it was worth, 154,000, minus what we actually got. And at the end of the day, although we sold it for 120,000, we incurred costs of 20,000, which means that the actual value is 100,000. So that means that our loss was actually 54,000. And if you have a look at the options given, thank goodness there it is as answer number D. And so that is your answer for question 4. A vehicle was part exchanged for a new vehicle. Which entries record the part exchange? Well, in this case, what's happening is your old vehicle is being traded in. And since you're busy disposing of it, you need to factor that into account. So what would actually happen is the fact that you're handing that over to your supplier of the new vehicle or your creditor of the new vehicle, what's actually happening is you are getting rid of that old vehicle, and you need to then transfer it out of motor vehicles into your disposal account to get rid of it. So that's why your answer is going to be D. A vehicle was part exchanged for a new vehicle. In other words, it was traded in. When you bought the new vehicle, you said you would hand your old vehicle over and then pay in extra cash in order to get the new vehicle. Which entries record this part exchange? Well, what is happening is obviously when you buy the new vehicle, there's now two parts to it. The one part is the fact that you're handing over your old vehicle, and the other part is the cash. So your new vehicle or motor vehicles account needs to be debited and you would credit bank for the cash portion, and for the trading part of it, you would credit your disposal account. Because remember, normally if you had to get rid of an old vehicle, you would receive cash for it or something, and in your disposal account, you would credit the disposal with cash or whatever you were receiving. In this case, you're receiving part of a new vehicle, and that is why your answer is then going to be D, because you're crediting your disposal account with your selling price of the old, and you are debiting your motor vehicles with part of the new motor vehicle that you are buying. Right, let's have a look at March 2016, paper 1-2, question 2. Why is depreciation provided on non-current assets? Well, what you're trying to do over here is you're trying to show them at a most realistic value, and you're also trying to offset the cost involved with that asset over its actual period of life as you generate the income. So you want to try and match your expenses, or you're looking at your accrual concept as well. So if we have a look at all the options that are available here, let's see which are suitable and which are not, so that the cost is allocated to the periods that benefit from them. Absolutely. Benefit from them in the sense that you can generate an income from the use of that non-current asset. So A is certainly an option. Entity concept, no. Remember, that simply means that your owner's transactions are separate from those of the business. That does not apply. C, so that there's enough cash in the business to replace them. No, the depreciation doesn't actually affect cash at all. Yes, it does affect your profits, and so in some ways, if you say you're only going to draw out the profits, then absolutely you might end up saving cash. But that's a bit of a long-winded way of going about it. Directly, it's not going to have any cash effect, so I don't like C as an option either. And then D, so that they're shown at market value. Not really. Partly, but not really. If you depreciate your assets correctly, then yes, ideally they would be shown at market value. That because of you want to have a true and fair reflection of the actual asset. But it's more than that. So D is a possible answer, but I certainly like A more, because that is really what we're trying to do. We're saying the asset cost us a certain amount. We now want to take that cost that we've spent and allocate it across its entire life. And so that's why I'm going to choose A as my answer over here. Question 3. The following information relates to the disposal of a non-current asset. I have a profit that has been made on the disposal, I have the original cost, and I have the proceeds from the sale. What was the accumulated depreciation on the non-current assets sold? Well, what I'm going to do here is I'm going to work backwards to find out the accumulated depreciation. What I'm going to do is, firstly, I'm going to say my sale proceeds, I got 6,800, and of that I made a profit of 5,200. So in other words, my actual selling price must have been the sale proceeds 6,800. Sorry, I lie, not the selling price, the carrying value. Oopsie, sorry. My carrying value, what it was worth. Oh, sorry, I'm jumping too much over here, trying to go too fast. Okay, so my carrying value, or my book value, must have been the 6,800 selling price minus the profit of 5,200, which gives me 1,600 as the actual carrying value at that time. If I then look at the cost of non-current assets sold, and I realize that my carrying value is 1,600, my total depreciation at that time must equal my cost minus my carrying value. In other words, it's going to be my cost of 14,400 minus the carrying value that I've just worked out, and I would then have an answer of 12,800, which is how I get to D as the answer for that question. Moving on to Cambridge, June 2016, question 2. The table shows extracts from the statements of financial position of a business, and then other information is provided, which amount was received from the sale of the non-current assets. Okay, so we've got a variety of information here, but we are trying to find out the actual selling price. Now, working backwards, if we can see that we made a loss on that selling price, if I'm able to work out what the carrying value was, I can then work out the sale. So I want to work out my carrying value, and I can do that by working out over here what my movements actually were. I quite like to do this, in fact, as a little tier count. So I'm going to insert a table over here. This is the fastest way to do it. If I just insert a little table like that. Okay. If I look at my assets over here, the easiest is to show it at carrying value. So I'm going to do my assets, my tangible assets, but I'm going to show them at carrying value. Now, obviously, I wouldn't write out all of that whole heading in an exam. I would just write TA at CV so that I know what I'm doing. And obviously, normally you wouldn't draw it up a general ledger account like this, but it's a wonderful tool to use to work out what's actually going on with the assets. So I'm actually going to ignore those figures there. You can use them and work them out individually, but this is much faster. So I know that my net book value at the beginning of the year was 115,000, and I know that my balance at the end of the year was 155,000. If I come here, I can see that my depreciation charged was 40,000. Now remember, depreciation would decrease the value of my assets. I just want to make my window here a little bit bigger if it'll let me know. Okay, well, never mind. We know that depreciation goes in on that side. And so I'm going to show the depreciation. And that's the beauty of doing this in one account. I don't need to suddenly have a separate account to show my depreciation. I'm doing it all at the same place. And the new non-current assets purchased at cost, I'm going to put in on the debit side over here, because obviously if you've got new items, you can factor that in. Now, obviously, if you've got your balance at the beginning, plus your new items bought, minus depreciation, minus whatever you sold. Now, this is where this is so useful. That is now going to be a missing figure, but I know what my end result is, and therefore I can work out my missing figure over here to find out what my carrying value is at that point in time. And the way that I'm going to do that, it might help you actually to show balance carry down if you want to. This is optional. I normally don't because it's a little bit more time consuming, but you might like to show the 155,000 over there if you're at all confused. So okay, now this window is really driving me nuts. Let me quickly remove my split so that I'm not so confused. There we go. So there's my tangible assets at carrying value. And I can now work out that amount as a missing figure by quite simply saying, well, if I want to find out what that amount is, I add these two together and then I subtract those two. So I'm going to say 115,000 plus 105,000 minus 40,000 minus 155,000. And that is then going to give me my answer. It would be 220 minus 40 is 80. 220 minus 40 is 180 minus 155 is going to give me 25,000 as the carrying value of the sold item. I then know from the information, let me quickly put my window back again before I now lose myself. I want to go to my question. So where was I? Over here. We know that the loss that was made was 10,000. So if my carrying value was 25,000, my selling price would have been my carrying value minus, carrying value, minus the loss. In other words, my carrying value of 25,000 minus the loss of 10,000. and that gives me 15,000, which is what I want as my answer, and that's how I get A as the option that I am going to use. Right. Question 3. What would be treated as part of the capital cost of the purchase of a building? Over here, capital cost of the purchase of a building, in other words, that means what am I going to put in my property asset account? The cost of the purchase, absolutely. So number 1 is an option. Insurance of the building is an expense that I would incur every single year, and I would be repaying it every year. So that is actually going to be part of my revenue expenditure. I would not use number 2. Number 3, installation of air conditioning needed for the machinery in the building. Yes, I am going to use that option, because if I'm installing the air conditioning, it's going to be there for a long time, and it's necessary for me to actually be able to use the building. So my initial cost and my installation costs, 1 and 3, are what I'm going to need, and therefore my answer is C. Right, let's look at 11. At 31st of December, the following information was available. I'm given my non-current assets at book value, my current assets, provision for doubtful debts and current liabilities. It was decided to reduce the provision for doubtful debts to that amount, and which effects will this adjustment have on the profit for the year and on net assets? Now, although they don't want specific figures given, it is still important to work out what we're going to do. In fact, no, I lie. In this one, if we want to reduce the provision, remember that as soon as you reduce a provision, that adjustment is actually an income, because it means that if your provision is getting smaller, in effect, your assets are actually getting bigger, and so the contra is an income. So what's going to happen is that the net effect on the profit for the year is that the profit for the year is going to increase, and so my answer must be either C or D. And my assets will also increase. Now, I know that sounds a little bit weird, but what's basically happening is that the reduction in assets is decreasing. So it's a minus minus, and that's why it's going to be an increase, and that's why my answer for number 11 is going to be D. Right, 2016 paper 1-2 in June, question 2. A company's financial year ends on 31st of December. On the 1st of April 2015, so partway through the year, in fact 3 months into the year, the following payments relating to a new machine were made. There's a purchase cost and an installation cost. Machinery is depreciated at 20% on cost per annum, calculated from the date of purchase. What was the depreciation for the year ended the 31st of December? There are 2 things we need to factor in here. The first thing is that the cost is going to be both the 50,000 and the 10,000, because your installation is part of the cost of getting that machinery working, and without that installation cost you wouldn't be able to use it, and so therefore it is actually part of your initial cost. So your initial cost is 60,000. Then you want to work out 20%, so you're going to say your depreciation is going to equal the 60,000 cost times 20%, but it's depreciated from the date of purchase. In other words, you're only going to depreciate it for 9 months. You're going to say times 9 over 12 in order to get your depreciation amount, which is going to be 12,000 times 60,000 times 20%, yes, is 12,000, times 9 over 12 is going to be 9,000, and that is how you get B as your answer for this question. A business purchased a motor vehicle on the 1st of January 2012 for $24,000. The estimated useful life of the motor vehicle was 4 years, and the estimated residual value at the end of the 4 years was $8,000. The business depreciates motor vehicles at 25% per annum using the reducing balance method. No depreciation is charged in the year of disposal. Just 2 things to quickly point out here. If you're depreciating on the reducing balance method, it means that you can actually ignore this residual. You'll only use this residual if you were depreciating on the straight line method, in which case you would have said cost minus residual divided by the number of years of useful life, and you would take off that amount each year. But since you are using the reducing balance method, it's simply saying that's what you're expecting to get. You could then perhaps even do a calculation to see if this 25% is realistic or not, but we don't need to worry about that for this question. So for this question, you can ignore that $8,000. When it says no depreciation is charged in the year of disposal, it's just making life a little bit easier for you. In reality, it is more accurate to calculate depreciation and then work out your carrying value at the date of the sale more correctly, but for the purposes of some of your exam questions, it's not necessary to do this. The motor vehicle was sold on the 31st of July 2015. Now, I'd suggest you highlight your dates quickly. This is the date of sale. It's in the middle of the year. So that means that because we don't charge depreciation in the year of disposal, we're not going to charge any depreciation for the 2015 year. However, you will charge depreciation for the whole of 2012, 2013, and for 2014. You are then asked, what was the profit on the sale of the motor vehicle? In order to calculate the profit, let's go back a step and first work out what was the depreciation each year. Because we are using the reducing balance method, it's actually important to calculate the depreciation right from the beginning so that you know what the carrying value is every step of the way. So the first financial year is going to be the 31st of December 2012. You would use that 24,000 cost that's given. Remember, ignore your residual, you don't need it, times 25%. That's because there's no depreciation to subtract yet, so you just do it on cost, and that would then work out as 6,000 Rand as your depreciation for the first financial year. Your second financial year is the 31st of December 2013. You first need to work out your carrying value at the beginning of this period, which is your cost minus the depreciation last year, which gives you a carrying value of 18,000. You now times that by 25% to get 4,500 as your depreciation for the 2013 year. For the 2014 year, you follow that pattern. You say, what is my carrying value at the beginning of this year, which in this case would be my 18,000. I can take my previous carrying value minus the last depreciation to get 13,500. Alternatively, you could say 25 minus 6 minus 4,500. You'll get exactly the same answer. So you use your carrying value of 13,500 times 25%, and that gives you a depreciation in the third year of 3,375. You can now use this to work out what was the carrying value when you sold it. Just a quick note. If this line hadn't been written, this sentence, no depreciation is charged in the year of disposal, you would then want to insert a calculation here that would only be for 6 months or 7 months until the 31st of July. So you would then say your 13,500 minus that depreciation times 25% times 7 over 12 for the current year. But luckily for you, you don't need to do it because of that sentence that's inserted there. So my carrying value is going to be my 13,500 here, or you could go cost minus each of the year depreciation, minus my last depreciation of 3,375, and that gives me a carrying value of 10,125. If we know that it was sold for 12,000, we can then very easily work out that the profit must be the difference between those two figures, in other words, 1,875, and my answer is A. $1,875. Question 4. A building was purchased for $500,000. The following costs were also incurred: adapting the new building, legal fees for the building purchase, cleaning the building, and the salary of the building manager. And we need to now choose which of these costs are going to be needed as part of this calculation. So obviously, we're going to use the purchase of 500,000 as the beginning of my calculation. I then also want to take into account, now well, let's have a look at each of these. Adapting the new building, 50,000. Yes, I am going to need that, because if I had to adapt the new building to make it suitable for me to use, that is a once-off cost that I'm not going to have again. Legal fees for the building purchase. Although legal fees feel like an expense, because it's for the initial use of the building, and again it's a once-off cost, I am going to factor in that 5,000. Cleaning the building, well, that is an expense that you are going to need to incur each year, so that will be part of revenue expenditure. I will not use it. Likewise, the salary of the building manager is going to be incurred every year, and I'm not going to use it as part of my cost. So do you see what I've done is the question I've asked is it a once-off cost or a recurring cost? All of these are once-off costs, and so I get an answer of 555,000, and then I'm going to select B as the answer that I need over here. And that concludes our multiple choice questions. I do hope this video helped you.